Martin, I mean, it would have to be a pretty substantial miss or beat for really this non-farms report to really move the needle on Fed expectations.
Yeah, no, very much so. And I think to some extent what we're seeing already is the bond markets are certainly to some extent factoring in a 178, 180,000 read on the employment side. But as you mentioned in your reports just now, the big issue is clearly going to be on both wages growth and the hours worked. I think the key here from a bond market perspective is that we've already seen a significant run up in yield. There's no doubt about that. The question for equity markets is at what point in time, what yield do we start impinging on the equity market returns? There are some out there in the market who feel that they'd be still comfortable with 10 years, US 10 years at 3%. But, that's obviously still very big moves from here. I guess to some extent the market also is having to get used to the fact that the incredible central bank stimulatory policies are coming to an end through this year. And we're heading more towards a normalisation, both at the economic growth front, but also in regards to those settings. I guess for us is the biggest risk is the inflationary pressures. Do they start to kick in? And how much of that is already accounted for in this rally in bond yields we've seen?
Well, 3% is also, incidentally, where a lot of very high-profile fund managers are saying is the start of a bond bear market, and that's where things really start to turn. Is that really so, though?
Well, I mean, is it really that much of a surprise? I mean, at the end of the day, we're starting to see the markets adjusting back to more normalised levels relative to where global growth is going. And we've been talking for some time, obviously, that we're seeing very strong data suggesting the synchronised growth and momentum is going to continue through this year and into 2019. So I don't think we should be that surprised that we're seeing bond markets move in line with that, and we're going to be seeing central banks starting to adjusting those settings, whether it's the Fed raising 3 or 4 times this year, and whether in fact we start to see the ECB tapering back their quantitative easing process. So I think that's on the cards. It's only a question of what are the expectations of the extent or the rate or pace of those changes by the central bank.